Good morning from London. I'm Anna Edwards alongside Lizzy Burden and Mark Cudmore. We're an hour away from the opening trade. Here's what you need to know. Markets whipsaw as President Trump denies he intends to fire Fed Chair Jay Powell less than 24 hours after floating the idea to Republican lawmakers. Donald Trump says he's notifying over 150 smaller trading partners that they'll face a tariff of 10 to 15%. He's also softening his tone on China as he eyes a meeting with President Xi. Plus, Germany rejects the EU's €2 trillion budget proposal, with Berlin saying the €700 billion increase is unacceptable.
Well, Anna, the kite went up and the kite went down yesterday. The president threatening, we hear, to fire the Fed chair, then backtracking on that mostly. So you had stocks suffering and then recovering. Nasdaq actually hitting a record. And US futures pretty flat this morning. European futures catching up to the optimism as things stand. But the real loser out of all the Fed drama was the dollar. It's getting back on its feet this morning. And cable very much in focus because, of course, we've just had the latest UK jobs data. We'll dive into that in just a moment. But when we look at wages, excluding bonuses, they rise 5% year on year. The estimate was for 4.9% of a rise, so only a very slight beat on that front. But the countdown to the opening trade starts right now.
He's a terrible Fed chair. I was surprised he was appointed. I was surprised, frankly, that Biden put him in and extended him, but they did. So, no, we're not planning on doing anything. We're very concerned.
President Trump speaking once again about the Fed Chair, Jerome Powell, and that's where we need to start our coverage this morning. That's where we start the agenda conversation this morning. Just to reiterate what we heard from the President, to give some further detail. I don't rule out anything, but I think it's highly unlikely that he fires Fed Chair Jerome Powell unless he has to leave for fraud. And that, of course, left the door open. It left the possible credible risk, at least in the market's thinking, about whether the Fed Chair could be fired. Of course, the market wasn't really thinking about that Yesterday, markets sold off, risk assets sold off as a result of the talk of firing him, and then really recovered a lot of their ground. But I'm not sure the story's over, Mark. We feel as if this is still a story in the market.
Yeah, what I think is really interesting is actually how much markets were kind of discounting this possibility until yesterday. There's a couple of facets to that. First of all, as you say, he can't really fire Powell unless there's with cause. Now, we suddenly got a new reason that seems to have come on the radar for that. But there's also, like, even if he gets rid of Powell, then he can't actually get rid of him from the governor role. He can get rid of him from the board, which is quite interesting. And then also you've got the fact that the committee doesn't have to go along even if there's a new governor anyway. And it would seem like they might push back. So a lot of people are saying he's never going to bother doing this because it's not sure it would work. It would just be such a damaging move. So it's amazing, even despite all that speculation, markets were pretty much kind of going, this is a very low probability until yesterday. We had a massive debate actually in advance as to what was priced in. Maybe 20% max, but even that was really quibbled. Suddenly people are going, oh my God, he might really do this. And what I found was really interesting, the surprise yesterday was the dollar decline, obvious. The steepening of the curve, obvious. What was interesting was how negatively stocks reacted. And it just shows that people go, this is just a terrible move for US institutional credibility.
And is that the guardrail on Donald Trump? Does he see that and then think, oh, this is a bad idea? And that's the idea that's being floated by Anna Wong, our chief economist, saying that maybe this is Trump testing the idea.
Yes.
That's why I refer to the kite flying. And actually, is that market reaction limited by the idea that this is just political theatre, and then does that egg Trump on?
Yeah,
I think you're right. I think, though, it's the taco trade again. Like, he saw the reaction. I think he might have been surprised by, stocks selling off, not liking this as well. Yeah. Because I think his whole idea is this will juice the stock market. So I think that's quite interesting.
Yes, indeed, yes, because you could make that argument, couldn't you, that if everyone saw rate cuts coming, then that would juice the stock market. But if the market instead puts Fed credibility and Fed independence to the fore, then that has a different impact. So the question is then, was it just a trial balloon? Was it a distraction? Because the domestic conversation around Jeffrey Epstein and all kinds of other things is not to President Trump's liking. He doesn't want to be talking about that. So perhaps we can expect, if that comes back onto the news agenda, then we get more of this conversation about Powell. Maybe it's all just ahead of the next Fed meeting, which comes at the end of this month, doesn't it?
Yes, and of course, speaking of taco trade ideas, we do have the trade tariffs deadline, which I really think is kind of superseding that next Fed meeting. To some extent, it's going to be completely dominated by what happens on trade. Of course, we had yesterday that there's, supposedly Trump's going to send out a 10 to 15% rate in letters to the other 150 countries that aren't kind of being negotiated about, especially. What's really interesting here is a big debate that's been had this year is whether it matters more to have policy certainty or the level of tariffs. Like, is it better to go, arbitrarily speaking, from 0 to 15% and just know that's it forevermore? Bit of debate in that. What I find is weird is that even if we do get 15%, can we be sure that's the end game? Does that give us policy clarity, given what we've seen so far? I'm not convinced.
Yeah, I don't know if this story ever comes to an end. When we've got President Trump in the White House, this is a tool he likes to play with, isn't he? And he might employ it or threaten to employ it in all kinds of unpredictable ways.
And take the UK as a case in point. Keir Starmer went for the certainty option, but he left the door open when it came to steel. If Trump's sending out letters of 10 to 15% for everybody else, surely that makes a mockery of the UK deal and going first and settling for this when you didn't know what was going to happen on steel. But interesting reporting from our colleague Lucy White today that actually UK officials are optimistic that the US is going to treat products that are made in Britain that contain European steel as British. So maybe there could be a bit of a resolution when it comes to the steel front.
I think thinking about global relationships and trade very much to the fore, of course, worth a mention of the China story that we had. Sources telling Bloomberg that the Trump administration, or parts of it, President Trump specifically, is deliberately adopting a slightly softer tone on China, which is a subject that will really matter to markets, of course, because he wants that meeting with President Xi. These sources also saying that what he wants is quick wins on trade. He's not really interested right now in addressing the fundamental underlying imbalances in the global relationship between China and the US. But views on that will vary in the White House, so no doubt those conversations get tense.
And the high-frequency data from China shows that we kind of seem to be seeing exports rise to a lot of those intermediate countries, even as it dipped to the US, which basically means that China's finding ways around some of the tariff routes anyway, as the superficial level. The final thing to say on this, I would say, is that, go to the UK thing, and I know making a mockery of the UK is kind of probably something we've seen several times in the last couple of years. But I think that getting that certainty does seem to help. The extreme example is Vietnam, where we saw the Vietnam trade deal seem to be at a high level, but you've just seen the Vietnamese stock market just go absolutely super soaring, kind of stellar. It's just that idea, we know what we're doing here. We no longer have to have this debate. We no longer have to be threatened. We can move on and get on with
as long as it is fixed and the US is a reliable partner. And that is a conversation we'll get to in the second part of this programme, where we have thoughts from the G20 on that subject. Lizzy, let's talk about the European budget, because this is a big plan, isn't it? 7 years, and it's gone up from gone up by 65% in terms of the scale and scope, the proposal at least.
Too much of a leap for Germany, it seems. Germany rejecting this proposal. As you say, it's for the next 7 years, and of course it was a big leap. They've got big aims with this money on defence spending, on boosting competitiveness in response to the Mario Draghi report, but a bridge too far for Germany. So they've got until 2027 to agree. It looks like the back and forth of these negotiations is going to carry on and on and on.
So is that 2.5 years we spent talking about this subject then? Is that what lies in store? Mark?
Look, don't get me started. You correctly identified I'd be pretty cynical about this. I just feel like, this is just another incremental story and something that's not going to matter for a long while yet.
Yeah, 2.5 years then we have to settle this. But at the moment, people are digging in and not agreeing to this initial proposal. We'll have plenty more on this story as we go through the programme. What else is coming up on the show today then? Melanie Baker will be with us, Royal London Asset Management senior economist. Lots to discuss there about the global economy in the face of all of these tariffs that we talk endlessly about. Roxana Minzato will be with us, EU Commissioner for Social Rights and Skills, Quality Jobs and Preparedness. It's a long title, but it boils down to a conversation about the European budget and about skills and about AI, perhaps. A little bit of the conversation could be around that. Koku Agbo-Bloua will be with us, Societe Generale CIB, Global Head of Economics, Cross-Asset Research. Lots to talk about with him then in terms of the Powell trade and what that looks like in markets with this threat. Does it still exist around what President Trump might do with Jerome Powell? Certainly the pressure still on. And Maria Vassilou will be with us, Head of Pictet Investment Research Institute. We will talk there about the relationship between the G20, the G7, the BRICS, the United States, all of those global relationships and global infrastructure very much in focus right now.
So that's what's coming up on the programme. In terms of what's on the economic docket today, at 10 a.m. London time, we've got the Euro area final CPI reading. Then at 1:30 p.m. London time, we get US retail sales and US jobless claims as well. Of course, we've already had a load of inflation data this week. Then we have second quarter earnings from PepsiCo out of the US before the market opens and Netflix after the market opens. And then we head over to South Africa. Jennifer Sabasaja on the ground for us, covering that G20 finance ministers meeting and the central bank governors around the table as well.
Yes, and thinking of data, time to just a moment just to circle back to the UK jobs numbers that you mentioned at the top of the programme, Lizzy. The headline on our Bloomberg story: UK firms cut jobs and wage growth slows in a cooling labour market. So that seems to be the top takeaway from Tom Rees and the UK the rest of the eco team. I'm slightly out of date as to whether we can rely on any of the UK labour market data right now. In keeping with other geographies, there does seem to be a reliability problem, and I know that's going to take time to fix.
You're not out of date. We can't rely on it.
OK, there we are. Thank you.
At least the UK kind of acknowledges it and sometimes doesn't publish it. You know, in the US, they just charge ahead anyway and put it out there.
I don't know, because you were on holiday, you may have missed. There's a new report out about the amount of the CPI items in the US that is now just estimated in the US. So basically, it's completely fudged, the whole US CPI. Honestly, the US situation is getting almost as laughable as the UK. That's quite a big statement, but it's getting pretty bad on the data side.
But look, this is a nightmare for the Bank of England.
Quality of data. If you can't make quality decisions, if you don't get quality of data to input into them, I suppose, would be the
thing.
And
then the fact that you've got the labour market cooling and inflation hotting up higher than expected yesterday. Headache for the BOE.
Yeah, we talked about stagflation and that the shadow of that a little bit yesterday on that inflation data. Let us talk to you about some of the other stories that you need to know about this morning and get a briefing on some global news flow. Syria's president has vowed not to allow the country to be dragged back into war following Israeli strikes on Damascus. Its military targeted Syria's military headquarters yesterday and moved more troops to the border. Israeli forces have stepped up operations this week after deadly fighting between Druze, Bedouin groups and Syrian troops in southern parts of Syria. The UK and Germany are set to sign a new treaty in London today that includes a commitment to assist each other in case of armed attack. German Chancellor Friedrich Merz, who's visiting the British capital, has vowed to join forces with Prime Minister Keir Starmer to confront challenges like Donald Trump's trade onslaught and the war on Ukraine. And JPMorgan racked up $30 billion profit in the first half, more than double its closest rival, and widened its lead over Goldman Sachs and Morgan Stanley in investment banking revenue. The bank's market value now exceeds that of Bank of America, Citi and Wells Fargo, all combined. But the CEO, Jamie Dimon, says all its competitors are growing and expanding, and fintech companies are plotting to take big chunks of JPMorgan's business. So really interesting in terms of the banking sector. Yes, he's got fintechs on his mind, and he's worried about that particular threat. But I suppose it's the strengths that come through in banking, really, in this most recent set of numbers. The expectation of a Trump administration was you'd get more M&A deals done. Actually, you didn't get that, but you got a whole lot of trading volatility, which has paid off big for traders.
Yeah, I'm not sure that's going to go away anytime soon, given we continue having new deadlines and fresh deadlines and excitement. So, yeah, I mean, banks are having a field down to this administration.
But you talked about the benefits of certainty, Mark. If you get an acceptance of uncertainty, do you get deal-making picking up in the second
Well,
half?
maybe. So maybe you get both, even with the volatility.
Exactly.
If deals come round to the idea that they might have to get done in a volatile environment, well, maybe.
I don't think acceptance of uncertainty works, though, for M&A, because how can you make long-term investment plans when you don't know what the policy is? I think this is going to be seriously detrimental. I mean, it's part of the reason why I think US stocks continue to underperform. I think the cost of doing business in the US is going to be a slow-moving story that we're going to see it play out several years, but it's risen significantly.
Yeah. OK, and again, interesting on your point, though, about the sustainability of this and the volatility of it. David Solomon certainly saying that he thinks this is sustainable, because the first thing you think about when you see all this trade, the money made out of trading and all of the volatility in markets that we've seen today, is you ask, is it sustainable? And his view is that it could be. So that's an interesting one.
All right, well, coming up on the programme, chip giant TSMC sees beyond the tariff cloud, posting a second quarter beat and forecasting strong demand. Plus, European automation powerhouse ABB sees order growth expansion in the US. So we check on those chairs at the open. But up next, Donald Trump says he's unlikely to fire the Fed chair, but do markets believe him? We'll discuss. If you've got any questions of your own for our guests, please do send them in on IB plus BB TV Go. This is Bloomberg. Donald Trump says he did ask Republican members of Congress whether he should fire the Fed Chair Jerome Powell, but now he says he has no plans to get rid of him. The US president was speaking after the closed-door meeting leaked to the media.
Have you drafted a letter?
I haven't drafted a letter.
So you didn't show a letter to Republican lawmakers last night?
No, I talked about the concept of fire him. I said, what do you think? Almost every one of them said I should. But I'm more conservative than they are.
Let's get to the market reaction with Bloomberg's Valerie Teitel. Val, what did we see?
It was a chaotic 90 minutes of trading, that's for sure, across all asset classes. We really saw a return of this Sell America theme. The dollar was weaker, the equity market lower, and the back end of the Treasury market really sold off aggressively. We also priced in an additional rate cut throughout the remainder of the year during this episode. Mark, I thought that was interesting for you to note. But really, this opened up just a whole can of worms on the reality. If Trump does dismiss Powell today, what happens tomorrow? Does Jerome Powell attempt to still go into the office tomorrow? Does he stay at home and the vice chair, Jefferson, step in? Does half the Fed board resign in support of Powell? And then how long does it take for Trump's new pick to get confirmed by the Senate? Aren't they off on summer recess? A lot of questions out there, but all of this could potentially be reversed by a Supreme Court decision months later that basically would maybe smack down President Trump's authority to even take Powell out of his seat. So a lot of big questions being asked by the market yesterday. We did see the poly market odds, the betting market odds of Trump dismissing Powell by the end of the year surge to nearly 40% yesterday. They've come back all the way to where they were 2 days ago, now hovering around 20%. Anna.
Valerie, thank you very much. Bloomberg's Valerie Teitel with some of the market response. She's very excited about this story. We can tell, and we thank her for the nice setup into our next conversation. Melanie Baker, senior economist at Royal London Asset Management. Melanie, it was clearly a dramatic day for markets, being sort of led up a hill and down again on this particular news flow. Was it a trial balloon? We don't know yet. We'll see where this takes us. What kind of assumptions are you making, and how material is it to your US outlook who the Fed chair is at this point?
So, look, I'm assuming that Trump keeps up his criticism of the Fed, what they're doing, and of Powell. I'm not assuming that he actually takes that step and fire Powell as a sort of central backdrop. But clearly it's generating a lot of uncertainty, and if he actually went down that path, things could be very messy indeed. In terms of does it matter, look, we know Powell's going to be going next year, and we assume that Trump will appoint someone who wants to cut rates, who's a bit more dovish. So possibly big picture, that in that sense, replacement doesn't matter, but it's the way it's being done and the risk of doing damage to Fed independence. Central bank independence is at the core of inflation targeting. It's something you don't want to mess around with.
OK, yes, and that seems to be the view we got from a lot of banks, certainly a lot of market voices, obviously, but also a lot of bank CEOs making that very point. And market response, one of the things that was very evident was that we saw lower yields at the short end of the US curve, and we saw higher yields at the long end, and that might be as expected if you thought the rate's going to get cut, and then if you thought there might be more inflation in the future. Is this something that we live with then now? Because even if there's no action taken, this is perhaps a reflex that we will see often in the market. So are you assuming that we see higher long-end yields in the US?
It's very tricky, right? I think we could have we continue to get a lot of news generated by President Trump. He may say one thing one day and something else the next, and I think it's just a recipe for volatility. Exactly where we go over the full year is quite difficult at this moment, with so many moving parts at the moment in the US economy.
Melanie, good morning. But does it really matter whether he backtracks or not? Like to me, US Fed independence under the next 4 years is gone. It's broken. I think it's going to take longer for everyone to realise this. But it doesn't matter. Whatever happens, it doesn't matter whether Powell stays at the end of his term. From now on, we know that there's just going to be non-stop commentary about interest rate policy from the administration. Non-stop pressure, non-stop criticism.
But if they don't react to it, if Fed officials say, look, actually, there are inflation pressures coming, tariffs are coming, if they push back, is that still evidence of a lack of independence? I'm asking genuine question.
Does it raise the bar on the economic evidence to cut? Does it actually, ironically, inadvertently make it harder to...
Well, actually, this is an interesting point, actually, because and so given that everyone says it's if they stand up for it, but one of the things we found out recently is just how much the data is being undermined in the US. We were just talking about that before you came to the show, not just in the UK, which has a bit of a bad record in this, but the US as well is having some problems with this data. More parts of the CPI inputs are getting estimated. So given that context, the data is being undermined. Does that cause even more problems to the Fed for trying to be independent and push back when everyone could say, like, look, you're having to fudge this anyway?
I don't think so. I think, as with the UK, what you do when you're not completely convinced about the main data is you look at a broad range of data. You look at the surveys. You look at, as a central bank, your own intelligence. And, of course, the Federal Reserve do that as well. They collect their own intelligence. We have the Fed Beige Book last night as well. I think it means that generally you have central bankers paying attention to quite a broad range of things, listening to firms as they're talking. It doesn't have to be a huge problem in that sense, but it does make life difficult.
OK. And so, just to clarify the answer earlier, you think that there's still a chance for Fed credibility to sustain? You're not giving up hope like me?
I'm not giving up hope yet. I'm not ready to do that, absolutely.
Well, I'm glad you're optimistic on this, sorry.
In terms of the kind of immediate story and eyes on September, does the fact that the tariff deadline's been pushed away mean that there's just no chance they're going to settle this debate on the FOMC, which we know is divided, on this question of whether inflation is going to be persistent or transitory because of tariffs? You're talking about having to look at a broader range of data. Are we even going to have enough data by then to decide whether to cut in September?
I think it's an absolutely really, really good question. I'm not convinced they will cut in September. I think it may come later in the year, largely for that very reason. I think what you may see is them paying more attention to what firms say they're going to do. I mean, again, a sort of Fed Beige Book talking about late summer as potentially seeing more of this coming through. So, yes, it may just take that little bit longer.
Yeah, because we're kind of waiting for the uncertainty to actually manifest in the data. I wonder when you think that's going to happen. We've got latest UK data out this morning, and it seems really confusing for the Bank of England as to what to do when you've got, CPI beating and then looking at the wage story, looking at the labour market story, pulling in different directions for the BOE.
Yeah, no, it's been difficult for a while, right? But look, I do think with the Bank of England, you have got evidence in the labour market data. It's bumpy, but evidence of slack increasing in the labour market. Vacancies continue to fall. There's sort of uptrend in the unemployment rate, falls in the payroll employees. And you've got businesses telling them that they're expecting lower wage growth next year. I think that's quite an important anchor point as well. It means that I don't think, against this backdrop, that sort of sticky inflation backdrop, that they'll be able to speed up the pace of rate cuts in any way for a while. But I do see them still on track for a kind of gradual pace of rate cuts. But yeah, against that backdrop, it's still gradual, careful.
Sorry, Melanie, I'm going to completely interrupt the flow here and cause problems because I want to go back to the US. How in the world can they cut in September, given you've got a labour market that's still holding up okay? You've just got the end of the disinflation, reinflation. We've just got the massive fiscal package. So we've got a fiscal tailwind, and now we've got the tariffs coming through. And stock markets are booming.
I don't know,
it should be
out, Melanie.
It should be. I want to be like, there's no way they're going to cut in September. It would clearly show that the Fed is gone if they cut in September. No?
I wouldn't say there's no way, because we've got quite a lot of data to come before now in the September meeting, right?
That's way too balanced a view. I mean, fine.
We could see a deterioration. The labour market data is key here, right?
Okay.
If suddenly we saw a real shift in payrolls, then it's all changed.
That's fair. And we've got two more NFPs to see from them. We've obviously got some other more high frequency stuff. But yeah, I'm fine. You're going to need to see quite a market deterioration to justify it, I think.
I'm sorry, Melanie. He's not going to be happy till you rule it out. But Melanie Baker, we'll have to let you go. Senior economist over at Royal London Asset Management. Lovely to have you round the table this morning. Well, coming up on the programme, Germany rejects the EU's €2 trillion budget proposal, and we'll discuss what happens next with the European Commission's Executive Vice President, Roxana Mintzatu. That's next. This is Bloomberg.
Welcome back. This is the opening trade. 30 minutes from the start of trading here in Europe. And we could be in for a pretty positive session, but this has a lot to do with the session in the United States yesterday. We got that confirmation from President Trump in the White House that he's not planning to fire Jerome Powell. There was some nuance, some caveat around that, but that was the broad message. We got that at around just before 5 o'clock UK time, which meant the markets had closed, and they'd closed around their session lows. And so we do need to see a bit of a rebound from those levels to kind of catch up with sentiment, the way it rebounded in the United States. So some of that will be kind of automatic. And then we'll lay on top of that, I guess, Mark, some of the earnings stories. We haven't had many of them, but we've had a couple this morning.
Yeah, absolutely. And I think what's really interesting is we're seeing that kind of still spill over from Powell into the bond market. We are seeing yields drift a little bit higher in Europe, and that's mainly a follow-through what we saw in US Treasuries yesterday. In fact, we're seeing the US curve, and it's most important now to probably watch the long end. Probably we're used to watching either the 2-year or the 10-year, but suddenly it's the long end. And it's a 30-year US now above 5%. We're only about 15 basis points from the 18-year high, the 18-year intraday high in 30-year US Treasuries. And as a result, we're up 2.5 basis points in US 30-year Treasuries. But as a result, we're seeing French bonds, German bonds, Italian bonds, all the major European bonds slightly weaker this morning. We're seeing about a basis point or so up across the curve.
So that's the read across from the US. But of course, we have to factor in the fiscal story. And yesterday we had Germany rejecting the European Commission's €2 trillion budget proposal just hours after it was announced by Brussels. Now, the pushback by the EU's biggest member state does point to the battle ahead for the Commission as it tries to get buy-in for its next 7-year budget, which begins in 2028. So for more, joined now by Roxana Mintzatu, who is Executive Vice President for Social Rights and Skills, Quality Jobs and Preparedness over at the European Commission. Really good to see you, Roxana. Thanks for joining us this morning. As I mentioned, of course, this was rejected by Germany yesterday, but there's a lot in here. I wonder, as you look at the proposal in broad strokes, is there enough to deal with the multiple challenges that the the euro area is dealing with at this moment?
Thank you for the invitation. That's exactly why the Commission has put forward a budget that is suitable for the challenges that lie ahead. The numbers are bigger, of course. The vision is to go with a budget that reaches almost €2 trillion, so that we are able to be balanced. At the same time, to continue to invest in the fiber of the political project of the European Union, the common agricultural policy, the cohesion policy, but also to be able to look forward, to be agile in terms of competitiveness of our economy, investing in defense, investing in the most innovative of technologies, and be able to develop Europe's partnerships. We are all looking at how Europe needs to become more powerful on the global arena, so the global gateway is also part of the deal. So it's not easy to cater for the present and the future at the same time. We think the vision is really balanced in this sense. Of course, the package does come with a proposal for new own resources. But as you've mentioned, and this is correct, this proposal is looking at a number of intense negotiations and debates between member states in the Council and in Parliament. It has always been so. Times are now ever more challenging. The geopolitical situation is not an easy one, so we do expect to have intense negotiations, but we believe this is a budget that is able to make Europe stronger.
Well, to those who say that the EU just isn't gripping the competitiveness issue that Mario Draghi highlighted enough, what's your answer?
Well, first of all, the message that we send is by increasing significantly the allocations for competitiveness. And we needn't just look at, there's 3 sections in the budget, not just at the obvious competitiveness tools, because yes, we propose a competitiveness fund that is some 500 billion euros, with Horizon Europe also doubling its amount, investing in research, in innovation. But throughout the budget, looking even at the cohesion policy, at the national plans, we consistently program or focus our resources towards decarbonization, smart strategic industries. And the vision is also that we have support for European added value, for European supply chain, for European value chain. So there is a new mechanism in this budget that aims to strengthen Europe's strong points in economy, obviously not being able at this point to reach the high numbers that Mario Draghi proposed for yearly investments in his budget. But this goes to future actions that we have. The European Savings and Investments Union, tapping into Europe's capital markets. It's not all just about this budget and just about these numbers. It is also about what we can leverage through this investment.
Roxana, good morning. Is there an expectation, though, that this is just a starting point and actually the budget will end up being a lot smaller than this? Germany says that this is too big, that this is not something that should be attempted when lots of member states are trying to consolidate their budgets, and maybe they have a point. How is this affordable for Europe?
As Mario Draghi mentioned, the only way forward so that Europe continues to stay strong is to increase its investments in key areas. But as he also mentions, and his Letta's report also mentions it, that doesn't mean that we need to sacrifice certain sectors such as the cohesion or the agricultural policy. It just means us being able to work together towards more EU added value action. So this is what this budget delivers. We think that diminishing this budget would be considerably weakening Europe's position in the global economy, in the geostrategic resetting that we are seeing. So this is indeed not a difficult, not an easy, let's say, vision to politically digest and translate into the political reality of every member state. But the negotiations that will for sure take place will allow us room and space to explain, to explore all the possibilities, and I'm sure to reach a conclusion that how this budget is structured is the balanced way forward, and we shouldn't take steps back.
And does Europe have the labour force, the skilled labour force that it needs to deliver on this budget, Roxana? Because there's a lot of pressure, or political pressure, on immigration policy, AI on the way, perhaps, and so a lot of competing forces. How do you make sure that the labour force that Europe has is the right size?
First of all, I would like to tell you that at least in the pillar dedicated to the allocations for member states, we have mainstreamed investment in social that includes skilling, reskilling of workers, investing in education, in technical education, in vocational training. So we have at least 100 billion euros there for this kind of investment in people. We need, however, to have a method, and the method needs to be that we need to invest more in adults, to reskill and upskill adults that are transitioning from one industry to another. And this is one solution that we put forward. In the Competitiveness Fund, for example, we propose the European guarantee for the skills of workers, which would mean investing in those skills that cater for the supply chains that are inside Europe and have a strategic added value. We do indeed have shortages, and this means also tapping into labor forces or labor resources that are not in the market, like women. We need to invest much more in childcare so that women can return or be present in the labor market for longer, for better jobs. And this is also an important part of the social investment that I guide in the Commission, and that is reflected in this budget. I would also signal the fact that we are investing in investing in universities. Our competitiveness, in fact, depends on the ability of our European universities to compete with the most important universities in the world. So we support, through Erasmus, the European University Alliances, so that together, as they join resources and through our investment and their own, they can get better at translating our brilliant talent, our brilliant education into innovation, into startups, into scale-ups, and that connects us with the investment we do through Horizon or through the new Competitiveness Fund. So there is a vision towards the future also for our human capital.
Roxana, good morning. It's Mark here. Just to follow on Anna's question there, I understand the upskilling, the amount of money we're putting towards that programme. I absolutely support the broadening of the workforce, but I feel we've ignored the big issue there. What about immigration? I mean, it seems like Europe does not have a clear plan for the future on an efficient solution for immigration. We're turning much more to the right. We've got this kind of labour skills gap. Are we just going to fill it through expensive upskilling, or are we going to, improve the immigration situation?
Actually, I think 2 nights ago, before the budget was presented, I was present in a trilogue, as we call it, a negotiation with the Parliament and Council on the EU talent pool, which is legislation on a new tool through which we are trying to match the employers in Europe looking for human capital, for talent outside of the borders of the European Union, and the job seekers that have the right profiles to come and work in the European Union. So we do prepare other tools. It's not just about investing in our own human resource. We are looking into bringing the adequate job seekers, those that have the profiles that match our needs, but also to be able to support that transition as they come into the European Union from the perspective of the services, of their families, of how they would, let's say, be integrated in Europe as they take on the new jobs. So there are a number of tools that we are looking at, and it is important that we tackle all those together, because Europe is an aging continent. There is a demographic issue as well. So inside this approach, we need to invest in but not just the workers that are in the labor force. We need to look at the young generation, how we can attract them to technical jobs. We have a crisis of engineers, of technicians, the so-called STEM jobs. So from firefighters, cybersecurity, IT, to water and wastewater systems, to steel, to chemicals, to defense, maybe even, because we are heading into a strong investment into our defense industry in Europe. We need technicians, we need engineers, we need technical workers, men and women. So this is also part of our vision and of how we are going to invest the budget through the national plans, but also through those that will be managed by the Commission directly.
And no doubt all of this would be made easier, Roxana, if we didn't have the uncertainty of tariffs and that tariff conversation across the Atlantic. Just briefly, if you could, how quickly can the US and Europe get to a resolution on trade?
I hope that these days and these weeks ahead of August 1st will be used to the maximum, and that negotiations would take us to a point where, through mutual agreements, we are able to safeguard jobs. Of course, I am the commissioner in charge of quality jobs in Europe, so not being able to have a fair trade agreement with the United States will very much hurt jobs, both in the United States and in Europe. So, of course, my colleagues, Commissioner Šefčovič is always present there discussing with our American counterparts. As I will repeat what the President of the Commission has always mentioned, that we are working towards an agreement. We think that the world that we live in has been shaped by a rule-based multilateral trade world. And diverting from it will create so much disruption socially. First of all. And this is something that we must be aware. It's not just numbers, it's not just economics, it is also our social model, not just here in Europe, but globally speaking. There has been, such an increase in prosperity overall for the planet by the fact that we have had an open trade system that was based on fixed and predictable rules. We need to find ways to continue to stay on the same path as we adjust the interest of the parties, and I think that is reachable and that is doable, but of course it doesn't depend only on the European Commission.
Thank you very much for your time, Roxana Minzatu, Executive Vice President for Social Rights and Skills, Quality Jobs and Preparedness at the European Commission. Coming up on the programme, we'll focus on some of the stocks to watch. Novartis shares could be on the move after the drug maker raised its profit outlook. This and other stocks that we're watching, that's next. This is Bloomberg.
.47 a.m. here in London, and in Taipei you've got TSMC's earnings conference underway right now. You can see it on the screen there. Now the chip-making giant sees sales growth of about 30% in US dollar terms this year, up from about mid-20% previously, and this is after a better than expected 61% jump in profit for the June quarter. Nasdaq futures have flipped into the green on the back of that positive outlook, and we can dive into it all with Bloomberg Tech Europe anchor Tom McKenzie, who's round the desk with us. Tom, just square this circle for us, please, because you had a pretty nice set of results from TSMC, but yesterday ASML walking back its growth forecast for next year. So how does that add up?
Yeah, and the context is, so there's this divergence that you point out. The context is you can't have these TSMC foundries churning out nodes or semiconductors that are more sophisticated than 7 nanometers and above, so 7, 5, 2. You can't have those without ASML's extreme ultraviolet lithography machines about the size of a bus that they ship in to TSMC. They have a very close partnership, TSMC and ASML. In fact, ASML gets about 17% of its revenues from TSMC. So there is a mismatch in terms of the guidance that we're getting through. Part of it may be down to the fact that the CEO, C.C. Wei, has been quite cautious in terms of his spend on these machines. They've been able to churn out chips at higher levels of sophistication without necessarily placing the big blockbuster orders that maybe some ASML investors had hoped for. But longer term, look, the build-out is happening in terms of these foundries in Arizona, in Germany, production facilities in Japan as well for TSMC. So they're going to have to fill those ultimately with these extreme ultraviolet lithography machines. And the question is, when they get to 2 nanometers, and when that starts to become a core part of their sales component, because that is expected to be beneficial to ASML longer term. But for the moment, it seems ASML is feeling more of an impact from the trade and tariff headwinds than TSMC is. The impact from TSMC, the fly in the ointment, is on the FX effects.
Tom, I'm a simple macro guy, and when you start talking about nanometers, you just lost me entirely, right? No, I'm only messing. What is the big kind of macro ticker? What is the signal for AI demand kind of over the next 6 months?
Well, that's why I threw the FX line in there.
I thought you were moving out for me, and then suddenly you went back to the 2 nanometers, and I'm like, oh no, I've lost it again.
So look, let's stay in your comfort zone then, which is broad, to be fair. But on the FX, it is interesting because they repeated this a number of times. The room is packed, by the way, in Taipei, but they talked about the FX effects because they book more than 70% of their sales in US dollars, and yet most of their costs coming, of course, booked in Taiwanese dollars. So the strength in the Taiwanese dollar, the weakness in the US dollar, that has been a bit of a headwind. And that means that for the third quarter, the current quarter, they've actually guided their margins a little softer. But the demand going forward, according to the CEO, C.C. Wei, is coming from AI sovereignty, so nations that are spending heavily on those data centers. He says fundamentally there is no slowdown in that AI demand. And a lot of analysts have said, is it going to be an end of 2025 story? Is 2026 going to start to look a bit soggy? There is no indication from what we've seen around the CEO and the comments on this analyst call and in front of journalists and analysts there in Taipei that is starting to happen. They also think they might benefit as these export controls are eased on NVIDIA's H20 chips into the Chinese market as well. So that could be another catalyst going forward. He says there are concerns on the geopolitics around trade and headwinds, but fundamentally their customers are not pulling back in terms of their spend on these chips. And you're thinking NVIDIA, AMD for that. OK,
so the numbers out of TSMC looking back and forward, looking good. Tom, thank you very much. Tom McKenzie with the update on the tech sector this morning. You can catch Bloomberg's interview with the TSMC CFO. That's with Wendell Huang. That conversation is coming up tomorrow here on Bloomberg TV. Let us get 3 minutes on the markets with Mark. And Mark, we know you are particularly animated with with the whole Fed dynamic. Anything left unsaid? Anything that we need to give extra emphasis to, do you think, when it comes to President Trump's criticism of Chair Powell and how this still sits in the market? I was wondering whether we get any clues from what happens at the short end of the US Treasury curve as to how much Fed independence there is. I suppose how much the 2-year moves on criticism from the White House.
I think that's a great way to look at it in terms of, like, we did see the 2-year come lower, but didn't completely collapse, which shows that there's some kind of belief that the Fed will push back. We talked about this earlier, but it's important to re-emphasize. We knew that it would lead to dollar weakness. We knew that it would lead to a steepening of the curve. It would be worried about long-end bonds. What I was surprised about is the panic in the stocks reaction. And I think that's the thing, that going back to what Lizzy said earlier, that might kind of say to Trump, like, this is a bad idea. But as I also discussed in the show with Melanie Baker, our guest earlier, I'm a little bit worried that we've lost Fed independence in the next 4 years. Saying lost Fed independence is too strong a phrase. I think its credibility is now going to be undermined to the extent because every single decision will be questioned. Were they being going too easy because some governors were fearing criticism and pressure, which means the backdrop here is that the US for the next few years is going to have easier monetary policy than it probably should be, or at least that's going to be the perception. That's going to continue to weigh in the dollar, which I believe in anyway for the next few years. We're going to have dollar weakness, and that's going to probably be lower front-end yields, but a problem for long longer-term yields, and that's a really big issue at the moment.
Mark, you talked about taco in the context of the Fed and Trump maybe chickening out on whether he fires Powell. Where are you thinking about it in terms of the tariff story? Because, we're coming up to that August 1st deadline. The NASDAQ just hit another record. It seems like at least the market thinks that Trump will chicken out when it comes to trade. Do you still believe that?
Absolutely not. I mean, I think the acronym is hilarious, but I don't think it's valid at all. I do think that he is worried about what's happened to markets, but I don't think on the short-term move so much. And I think, one of the most consistent things that Trump has always said is he loves Trumps as a policy tool. He thinks they're important as a geopolitical policy tool and for revenues. He really, really goes on about that. And that this was long before he became president this time. He talked about it a lot in between his two administrations. And so there'll definitely be tariffs. It's just about what level and in which countries. But it looks like we're heading to a world. So it's 8.5%, 8.8%, I think, in May. I think we're heading to a world where the average effective tariff rate in the US is going to be, 10 to 15% versus, around 2% for the last 25 years average, 2.3%, I think is the last 25-year average. So that's going to be seriously damaging for US business. And I think markets have not fully priced that, and I think there's going to be problematic. So I'm having been positive to stocks the last couple of weeks, thinking the fiscal tailwind would help us rally through the July 9th deadline. I've now quite bearish for the next month and quite worried how the deadline plays out.
And quite worried how high long-end yields might go then.
Yeah, it's a double tangent. So we've got the trade and we've got the long-end yield situation. And the long-end yield situation continues to get worse. And it's not helped by those incremental stories on Powell at the moment. And the problem for long-end yields is it's global. It's, and we've got many catalysts coming up. We've not just got trade, but for example, this weekend, we've got the upper house election in Japan, and JGBs are playing a large part of this. We know the UK has got its own issues as it kind of heads to stagflationary dynamics. So it's a global issue in yields, and this is negative for stocks.
OK, thank you very much. Bloomberg Markets Live Executive Editor Mark Cudmore with 3 minutes on the market. We have a host of stocks also in focus. ABB could be one that gains. Data centres, we talked about that in the TSMC context. That could be in focus for ABB as well. A decent story out to the US for them. So we'll watch that one. Novartis also in focus. We will be back with the market open here in Europe. That's next. This is Bloomberg. Trading. Futures have been pointing higher, and this is a very nice chart to explain why that is. This is the session here in Europe yesterday, so the white line is the session. Towards the end of our session here in Europe, we dropped a lot, and that was on the back of the speculation that President Trump was about to fire the Fed chair. Now that after Europe closed, just around 5 o'clock UK time, we got the news lines out of the White House, out of the Oval Office, that President Trump wasn't going to. There was some caveats and some careful language around that. But he's not planning to fire him right now. And as a result, we saw US stocks, and that's what we see in the blue, jumping up. And so to sort of trade in line with the US sentiment, we need to make up some of that ground, which is a nice explanation as to why we've got Euro Stoxx 50 futures up by 0.7% right now. DAX futures up 0.6%. FTSE futures expected to go a little bit higher. Not quite the same beta play then on the FTSE as we've seen on other markets, Lizzy, which I guess given recent performance, yesterday's performance might make sense. What are the individual stocks and sectors that you're watching?
Well, we were just talking to Tom, of course, about the TSMC earnings, and therefore chip stocks are in focus. Of course, we also had ASML earnings out yesterday, so contrasting outlooks from the two of them. TSMC raising its 2025 sales outlook, a big boost for AI chip demand, so we keep an eye on the chip sector. We also mind Novartis, the Swiss drug maker, of course, lifting its outlook after its quarterly profit beat estimates. And then staying in Switzerland, I've thrown in the Swiss industrial firm ABB, also posting results, strong order growth on rising demand from the US. So those in mind, but futures, as you say, Anna, pointing positive here in Europe.
Yeah, we'll see if it's a day where some of those earnings stories cut through, or whether it's the general Fed-induced or President Trump-induced sell-off and rebound that really captures the market's attention here in Europe in the early days. Perhaps it is the latter of those in the opening moments of trade that we will be watching out for. So the FTSE 100 is open, the rest of Europe yet to get there. But the IBEX up by 0.5%, expecting then to see quite a firm rebound in stocks after yesterday's weakness as a result of those the President Trump lines, or the reporting around President Trump's lines, the things he said to Republicans about whether he should or should not fire the Fed chair. As a result of that, then, we see stocks here in Europe rebounding up by 0.7%. The FTSE 100 up by 0.5%. So, Lizzy, that seems to be the dominant theme this morning. It's all about that big picture Fed narrative, whether we have Fed independence. Mark raising an interesting question earlier on about whether this was always going to be stocks negative, the speculation around the Fed chair, because if the markets had taken a rate cut as a positive thing, then it could have been stock positive, but it wasn't seen that way by markets. Risk assets sold off and then rebounded on Trump's denial, and we need to price some of that in here in Europe.
Yeah, so when we look at the sectoral breakdown as things stand, tech, as you might expect, the best performer this morning, top of the basket up 1.4%, and this comes back to TSMC raising that 2025 sales outlook. As I say, a big boost for AI chip demand, and individually, some of the individual stocks that we're watching, I mentioned Novartis lifting its outlook on this quarterly profit, beating estimates, shares up about 7% this year, but actually Novartis shares down 1.9% at the open, so not enough for traders, it seems, those results. Then we have to look at Volvo. So we've had results from both the cars side and the trucks side. If we take cars, their income fell in the second quarter because of tariffs hitting sales. Volvo car is actually up 6.3%, and Volvo truck earnings beating estimates because of firmer European market demand, and Volvo truck is up 2.9%. We've had results from ABB and Ocado, waiting for those to start trading, but at the moment, as things stand, Anna, as you say, on the Euro Stoxx 50, we're up 0.9%.
It looks as if ABB is halted, Swiss-Swedish, so listed in both places, and we'll wait to see some response there. It is an interesting story. I was taken by a few angles on this one. We had strength in the US, which I thought, given all of the volatility and the conversations around market uncertainty, meaning that businesses won't invest. I think it's interesting that this is a business that sells automation services and other industrial products, and if their clients have the appetite to invest, that's an interesting narrative around the US. And the fact they're exposed to data centres also tells us something about where that investment is coming from. Autos, on the other hand, is part of their business, and that's a negative. But we have seen some suggestions that this one will go higher at the start of trade, so we continue to watch that one, of course. But anyway, that's just one stock in a sea of many.
Yeah, and of course, as you say, the real dominant narrative really is about the Fed Chair, Jerome Powell, and whether he's safe in his job. So let's discuss further. We have Agbo-Bloua, who is Global Head of Economics, Cross-Asset and Quant Research over at Société Générale Corporate and Investment Banking, with us round the desk. Good morning.
Good morning.
I want to start with the Fed then, and whether the market's underpricing the risk that actually the President is going to fire the Fed Chair.
Yeah. Well, I think it is ultimately not a new news, because we've seen these remarks a few times. I think the market is clearly afraid of having a repeat of Arthur Burns, who was the Fed chair from 1970 to 1978, with President Richard Nixon, where he ultimately didn't raise interest rates because Richard Nixon at the time said, I didn't care about inflation, but wanted full employment, and that's essentially why we had this spike in inflation in the 70s and 80s. But I think the key theme is to remember that the Fed chair does not dictate policy by himself. It's a committee. So ultimately, he's one vote amongst many of the board members. So we have his term ending late 2026. So I think firing him wouldn't make sense given the timeline. There are already candidates to replace him. So I think the focus will be on them. But even if we have someone who's more dovish and willing to cut interest rate, we do not think that this will necessarily mean the end of the independence of the Fed.
OK, that's interesting. And it's interesting that you mentioned the Burns example, a nice history lesson to start off the day.
Thank you, Coco.
Yeah, do you just kind of ignore if there's a kind of political appointment to the Fed chair? Because, as you say, you've got the rest of the FOMC there, and it doesn't really matter what the Fed chair is saying. How would the market react immediately and longer term if Trump fired Powell?
Well, it will react pretty badly because, as you know, at the end of the gold standard, and it was the Nixon shock, the dollar is not backed by gold anymore. So it's essentially based on the full faith and credit of the United States of America. So it also means that any sort of central bank biggest asset, its credibility. So if that were to go through a firing, the market will take it very badly. I think we would have pretty significant amount of volatility. But then it's an interesting situation because you would want to think about who will be the replacement, but that simply is going to increase volatility for asset prices and lack of confidence in the dollar, which has been one of the big themes this year.
So weaker dollar, more volatility, markets react negatively, then you say risk assets would react negatively. How concerned are you about long-end yields then, Koku? Tie that into because it's easy to think, well, maybe if there's going to be more inflation, if there's a different Fed chair, then there's more need to price that in at the longer end. But is there something about the institutional credibility of the United States and the reliability of the United States as a partner that gets priced in at the long end as well?
Yeah, I mean, this was one of the big themes of this year, the whole deglobalization or de-dollarization, the end of U.S. exceptionalism. But as you saw in the data, well, I mean, the S&P is back up to a record. It is underperforming Europe. That's up sort of 10 to 20%. But one of the things you have to realize is that the U.S. equity market is roughly $60 trillion. NVIDIA is $4 trillion. The Eurostoxx 50, top 50 companies in Europe, is $4 trillion, roughly the same size as NVIDIA. And the total European market is 14 trillion. So the size of the US market is just enormous. And going to the bond market, we have the steepening yield curve across the board, gilt in particular. But this is, in my opinion, going back to normality in terms of the yield curve after decades of quantitative easing and distortion by central banks. I think it is also reflective of the sort of worsening budget deficits of the fiscal policy in the US, but it's also linked to this original sin that we saw after the pandemic in 2020, where government spent trillions to save human lives and corporates. So I don't think it is an issue in the short term. I think it just adds more risk premium. But a lot of investors are worried about another Liz Truss phenomenon in the US, but we don't believe in that scenario.
Okay, but do you feel confident enough in pricing in steepness, though? You think that the US long-term, the direction for long-term yields is higher because we lived in a world where rates were really, really low, then government spent a huge amount of money during the pandemic, and then at some point that's got to all be paid for?
Yes, that needs to be reflected. So investors need to be compensated for the additional debt. So we have roughly 30 to 36 trillion, depending on how you account it, for the U.S. Economy. And this needs to be reflected in higher risk premium. So you get better carry. And at some point, you could have the bond vigilante forcing governments to tighten.
That does sound like a Liz Truss moment, but you don't think that's coming?
That's probably going to be later. I think if we were to hit like the 6% type levels, then I guess this will create a bit more volatility. The last comment I also say is that there are changes on a regulatory standpoint, like the SLR, for example, that's been talked about quite a bit. That could potentially increase the buying capacity of U.S. banks, of treasuries, by alleviating the pressure on their balance sheet, so maybe $2 trillion of buying capacity. So that potentially could offset as well.
So that could mean that we don't necessarily see such a spike up in long-end yields like we did some months ago when banks found they couldn't buy enough long-term debt because of the restrictions on their balance sheet. Yeah,
so that could be that. But then there's also some discussion that it may benefit the shorter part of the curve than the long end because of the volatility we've seen. But yeah, let's watch this area for sure.
Can we just talk about tariffs? Can I bring back that word of Jamie Dimon's, complacency? Is the market too complacent about what trade deals are going to come around by August 1st, do you think, Koku? Well,
this is a brilliant question because as we all been going through an environment of heightened volatility there's a derivative term that's called heteroskedasticity, which comes from Greek that says high volatility or volatility. So the key point is if you have an environment of high volatility, then you can hedge and buy volatility and see what you expect. But periods of back and forth is what makes things very complicated for investors. So if you look at the sensitivity of markets to Trump comment, it has decreased because at some point, fool me once, shame on you, fool me twice, shame on me, and then you should fool me 10 times. At some point, you just stop playing. And I think it leads to this interesting phenomenon where when we talk to investors, maybe the best trade, the best position is to have no position, or at least the reduced position, given the uncertainty. So our base case scenario is that this will be extended, but if it doesn't, then the market will react, and that will force maybe another tackle, as the term goes.
So you do still believe that somebody chickens out at the end?
Yes, absolutely. Because the cost of having a full-blown trade war, and one thing to monitor is if this were to go into services, because 70% to 80% of GDP in the Western world is services, not goods. And Europe has mentioned potentially retaliatory measures in services. Think about tech, financials, etc. So I don't think we want to necessarily go there at this stage.
OK, Kokou, thank you so much. Thanks for your time. Kokou Agbo-Bloua, a global head of economics, cross-asset and quant research at Societe Generale Corporate and Investment Banking. European equity markets then rebounding from yesterday's lows. A lot of this, of course, driven by the commentary from the White House about firing Jerome Powell and then not firing him. And we see the rebound due to the latter part of that statement this morning here in Europe. So Stock 600 up by 0.6%. How does that play out for the core six? We see quite a lot of divergence here. Schneider Electric really strong, up by 5.9%. Some of the other names there, Ferrari also up by more than 1%. Novo Nordisk on the back foot, down by 0.9%. Let's check in on some of the individual stocks, though, that are on the move this morning. Chloe Melly joins us. Good morning, Chloe.
Good morning, Anna. Let's start with some good news over from ABB this morning. It reported a really strong uptick in order growth for its automation tools for factories, especially from the US. And the CEO said that it expects this year to be a record year for ABB. And that is pushing the stock up almost 8% this morning. Quite a significant move. Moving on to ASML. ASML is also up this morning. It had quite a tough day yesterday, but today it's off the back of TSMC upgrading its projections for 2025 sales, and that is pushing up ASML up 2.3% this morning. So rebounding after a tough day yesterday. Moving on to another aspect of this AI story, data center equipment. So Legrand raised its 4-year sales target. Legrand makes infrastructure cooling equipment for data centers, and it's really benefiting from this AI boom. And Schneider is also being brought up as well alongside it as one of its key peers. And then finally, another good positive move from, it was positive at the open. Novartis is actually down now, but Novartis raised its guidance for the year on the back of really strong sales for its cancer drugs, and it also said that it was going to have a new buyback and launching a new buyback. But it seems that that was not enough for investors, and it is down 2.2% this morning.
Chloe, thank you very much. Chloe Melly from our equities team with a rundown of some of the stocks in focus. We've got some numbers out of Ocado this morning. Ocado maintaining its full-year technology solutions revenue forecast. They still see, they're sticking to their forecast, but we've got a price for them this morning. They go up by 10%, so that's the reason to mention it, the fact that they are up so substantially this morning on grocery retail.
Yeah, pretty good, because, of course, they've got to deal with that rise in the minimum wage. That was thought to be a hit to Ocado, but a stonking performance, best on the Stock 600 this morning. But coming up on the programme, we'll get to more earnings out this morning. Volvo Cars' second quarter revenue beating estimates. So we'll bring you more on the company's earnings results and cost-cutting strategy next. This is Bloomberg.
We are well on track with the indirect cost savings. Then we also work to save around 3 billion on the direct cost side. And then we have a very good cooperation right now on the really part number level with Geely, where we are looking into to see how to bring down that. And then the big chain is then with cash and working capital measures, which is showing very good result.
Hakan Samuelsson, CEO of Volvo Cars there, speaking to us a bit earlier. And that interview came after Volvo Cars reported second quarter revenue that beat the average analyst estimate. So for more, let's bring in Bloomberg's Global Autos editor, Craig Trudell. Craig, it seems like they've been hit by tariffs, these sales from Volvo Car, and a plea we had from the CEO there as well when it comes to tariffs, speaking to the EU.
Yeah, I think Mr. Samuelsson has a sort of message for Brussels that essentially, puts a little bit of the blame on them for the fact that there's so much tension between the EU and the U.S. from an automotive trade perspective. He has a point here in terms of the charge that the EU was putting on imports of vehicles from the U.S. That being said, this is now a case where it's gone from a little bit lopsided in the EU's favor to lopsided in the U.S. favor, and there's of course some sort of fine print here that there's not a whole lot of issues with trade from a tariff perspective. This is more so a problem of a mismatch between the types of vehicles that are bought in the EU versus what the US is making and selling.
Yes, Craig, good morning. So do we have the sense that a lot of European car makers might share this view, telling the Commission, look, let's just cut tariffs on US imports of cars into Europe, because European customers often drive on roads that are too small for them anyway, need to park in spaces that are too small for them, so not many of them will get sold anyway, even if they are tariff-free. Would that be a line of argument that lots of car makers would agree with?
I think they would prefer to see, both sides, disarm, right, and take tariffs down. I think the likelihood of that happening, given the sort of approach of the Trump administration and the views of the president, when he talks about trade, cars are sort of, an industry that is at the tip of his tongue. It's a way for him to sort of hammer the rest of the world in the sense that there aren't a lot of major countries where the U.S. has a trade surplus, right? And so this is a sort of industry that is consistent with his worldview that the U.S. is being treated unfairly. And I it does not feel like there's a particularly high likelihood that the U.S. is going to go closer to zero after all these years of the U.S. not being on equal ground with these other countries, or being in a position where there are so many cars coming into the U.S. From other markets. There seems to be a sort of bias toward let's go higher as opposed to let's bring each other's tariffs down.
Yeah, so that could be the thinking that gets in the way of that tariff disarmament that you described. Craig, thank you very much. Bloomberg's Global Autos editor, Craig Trudell. Let's pivot on to other earnings stories we've had out this morning, from Volvo Cars, which is up by 8.7%, to ABB, where shares are surging this morning after posting a second quarter beat and reporting strong order growth. The CEO was on Bloomberg earlier this morning and talked about how tariffs are impacting his decision-making.
That clarity on what will have an impact, where the tariffs are going to end, especially between Europe and the United States, but also inside North America. I think those are where we see trends where kind of decisions are not cancelled, but they are delayed. They are postponed, just in the wait there to see. But so it probably will take a quarter or two, but it's very hard to predict when the trade deal is struck these days.
So this is a business, Lizzy, that is, on the one hand, yes, it supplies the auto sector, and that's not going to be a great place to be right now, but it also supplies data centres, it supplies automation and factories of all kinds, robotics, process automation, power products. All of these products, when you're in a world of electrification and moving towards more electricity use rather than other forms, in high demand, it would seem.
Yeah, so good news that for ABB. I also just want to take a look at EasyJet. We just put the price on the screen there, down 6.9% as things stand. It's the second worst performer on the Stock 600, and this also comes back to earnings, but the theme is different. It's not a tariff story here. Their profit growth has been hit by fuel costs and strikes, those French ATC strikes, and the CEO, Kenton Jarvis, says he's extremely unhappy with those French strikes because of the unexpected and significant costs for carriers that they created. So EasyJet shares really suffering this morning off the back of those results.
Yeah, absolutely. I mean, getting a sense of the cost and the disruption that kind of strike activity brings for these businesses is, I mean, it's something that sometimes has an impact on shares, sometimes doesn't. But it is a sort of perennial risk for companies that operate in Europe that you're going to have to face these kind of delays. Let's pivot to another sector where we've also had numbers out this morning. Turning now to the healthcare sector, Novartis shares have been on the move this morning, now down, as we were hearing from Chloe earlier, despite the Swiss pharmaceutical company raising its profit outlook after reporting better than expected results for the latest quarter. Sometimes that isn't enough. Bloomberg's Europe healthcare reporter Tim Lowe is with us. Shares are down then, Tim, despite the fact that the earnings, there seemed to be some positivity in there. What is keeping investors wary?
Yeah, there's kind of two factors that are a little bit disappointing this morning for investors. The first is the CFO, longtime Harry Kirsch, announcing he's going to be stepping down next March. He's really considered a rock star in the sector. One analyst note this morning referred to him as widely regarded as the best CFO in the whole industry. So, I mean, he's been CFO for 12 years, so he's kind of earned his retirement. So that is, I think, perhaps disappointing investors a little bit. But the main thing they're also zeroing in on is one of Novartis's top growth drugs, a psoriasis medicine, came in disappointed in the quarter, and that was driven by a little bit of weakness in the U.S., but also primarily in China. So those are sort of the bearish signals this morning.
But is it all doom and gloom at Novartis this morning, Tim?
Definitely not. As you mentioned, they raised their profit outlook for the year just a tad. It wasn't a massive raise, but their two new cancer drugs that they're also going to be relying on overperformed in the quarter, so that's good news. I would say, generally speaking, much of their statement came in more or less in alignment with expectations. So I suspect a lot of the focus is going to shift later in the day to the analyst call with the CEO. He's already in the U.S., and they're going to be talking about, tariffs in the U.S. and U.S. drug pricing and how that's all going to evolve.
Yes, is that going to be the focus for investors then as the day develops? Because drug pricing in the United States, I think I've been asking big global CEOs about that subject for about 20 years, Tim. Are we going to get some real news lines on that, do you think, under President Trump?
There's certainly a lot of news. The question is when it sticks and when it really, comes into effect, which is creating all this uncertainty. So there's going to be a lot of people training in to listen to Novartis' CEO today as he talks about it. Again, Novartis is the first big European pharma company to put out earnings this cycle. So a lot of focus on what gets said later today.
All right, Bloomberg's Europe healthcare reporter Tim Lowe, we thank you for that update on Novartis. As we look at those shares down 1.6%, a much bigger mover, though, I will take you to is Wise out of London, down nearly 8% this morning off the back of their results. Underlying income missing estimates, this across the London-based fintech. So those shares really suffering off the back of those results.
I'm all about data centres and engineering, it seems, this morning, because Legrand over in France, Chloe put this one on our radar, didn't she? Legrand, there we go. Yes, they design and manufacture electrical devices, but crucially one of their customer bases is data centres, and there again we see some positivity. So just like ABB, that's playing out well for them, and that seems to be lifting the likes of Schneider Electric. So the CAC 40 is actually up by 1%, the DAX up by 1%. So a solid rebound, perhaps on some of these earnings stories, but also, of course, big picture on the rebound from the White House Fed-induced sell-off of yesterday that we then had to catch up with this morning here in Europe. Coming up on the programme, finance ministers from the world's biggest economies are meeting in South Africa. We will discuss what is on the agenda with Maria Vasilou, head of the Pictet Research Institute, next. High-level delegation from the United States is missing at that G20 meeting. How do we weave that into our expectations for emerging and developing markets going forward? This is Bloomberg.
The This is the opening trade. We're 30 minutes into today's session. You can see it's green across the screen for European stocks. But we want to go to South Africa now because the world's most powerful finance ministers and central bank governors are gathering there for the G20 meeting. Attention, of course, is firmly focused on limiting the fallout of the global trade war. But South Africa's central bank governor has expressed confidence that the G20 can reach, this time, a communique.
It would be great if we have a communique, but if we do not have a communique, it's not a train smash because the conversations continue.
Let's speak to Jennifer Zabasajja, who's on the ground for us. And Jen, what's the sentiment there? What are you hearing about the current trade tensions? Tariffs, of course, dominating the conversation. Well, we'll get to Jen in just a moment.
We don't have an answer to that just now, do we? It was interesting. I was reading a lot of our coverage about the G20, and clearly the fact that the United States is not there with a high-level delegation is going to be
absent.
Right, absolutely. So that's going to be something of a focus because not having, one of the big architects of the global economy there and present might limit the ability to deal with a lot of the issues that the G20 wants to deal with. And of course, the US providing a distraction in the shape of tariffs from the things that the G20 wants to talk about. Things they did want to get on to discussing, I understand, debt forgiveness, climate change, all of these sort of perennial themes for a gathering like the G20. But yeah, without the US, you wonder what kind of progress can be made.
Yeah, well, let's actually analyse this first because we'll wait to get to Jennifer Zabasajja. But in the meantime, we're joined round the table by Maria Vasiliou, who is head of Pictet Investment Institute over at Pictet. And you've been writing about this, Maria. Good morning to you.
Good morning.
As Anna mentioned, you've got the US Treasury Secretary Scott Bessent absent from the G20. I wonder what that means for the nations and what it says about the US as a reliable trading partner. Is it reliable?
Well, we are going through a period where we basically have U.S. against the rest of the world, and U.S. is trying to change the terms of trade, the way the nations collaborate, and so it's no surprise that at the time of intense negotiations around trade deals with the rest of the world, the U.S. would not want to be part of this gathering. Also, what we're seeing is the emergence of a bipolar world where in one side you have US and the G7 and on the other side you have China with the BRICS. And so the importance of G20 is a little bit diminished, I would say, at this point.
Well, yeah, on China, we've got reporting saying that actually behind the scenes, Trump seems to be softening his stance when it comes to China. Is that what you're seeing? And how does it change your expectations of where that trading relationship ends up? Because, you've seen Trump conceding ground on chips, for example. Does it say to you that actually he's more concerned with getting deals over the line than he previously seemed to be about national security?
At the end, I think both President Trump and President Xi are rational leaders, and so they would want to have a positive sum game deal. And China has a short-term problem because it needs the U.S. markets to promote its products and maintain its growth rates. But if it manages to do well in the short term, it has a great trajectory. U.S. has a better short-term outlook, but it has a problematic long-term outlook if it doesn't manage to maintain its leadership in technology, manage its debt overhang, and so on. So there is room for collaboration between the two, and I think that's really what you're observing.
Away from the relationship, that bilateral relationship, thinking about the role that the US is playing in global trade right now, Maria, when we've heard from the White House on their stance on global trade, some people say, well, global trade is now off the table, it's a different world we now live in, much more bipolar or multipolar, for example. Is it possible that we end up in a situation where the rest of the world trades more with other parts of the world? It's just the US that takes it out of the equation, or is the US setting the direction of travel for all?
We have already observed that the trade, for instance, within BRICS Plus has increased about 200% in recent years. And that's at the back of the sanctions that the US and EU have imposed on Russia. Certainly, there is a sense in the rest of the world, and particularly among BRICS and among Asian nations, that they need to find ways to hedge against their dependence on the US. So some level of disentanglement will happen. I don't think that there will be no trade between the US and the rest of the world. But in a way, we can also make the counter-argument that trade had gone too far and it had created a lot of unintended consequences.
Yes, and so does so other developed nations, do they actually fundamentally come on board to the US view that trade and globalization went too far, the benefits were exported and the negatives stayed at home?
We have two examples that really support this argument. One was the Great Recession of 2008, where we saw that countries that were too specialized had a hard time recovering from the crisis. And the second example was COVID, where whole economies got paralyzed, even for production of domestic products, because they were so much dependent in their supply chains from other nations. So, and also, if you look at the U.S., manufacturing represents only 19% of the economy. That's a very low number compared to the rest of the world. For example, in China, 45% of the economy is manufacturing. So certainly the U.S. will not go up to that level, but there is room to increase. And at the end of the day, what nations should be focused on is increasing their economic resiliency. And that has really suffered under globalization.
Maria, of course, a consequence of this US trade policy has been dollar hegemony weakening. Do you see a viable alternative out there in the other nations that you're looking at? And on what time frame could that happen?
The reality is that there is no viable alternative to the US dollar at this point. And even countries like China may not want to create an alternative, because that comes also with a lot of responsibility. They may not want to extend their external debt to the level that the U.S. has done. They may not want to open their economy to the level that the U.S. has done. So I don't really see a credible alternative. People talk about the euro, but the European Union would have to do a lot of reforms, deepen its capital markets, its debt markets, create common issuance and so on, which are not on the pipeline at the moment. And so I don't really see a credible alternative. What we are seeing is a really very focused effort to bypass dollar settlement systems. And so that is happening, but that does not amount to de-dollarization.
And is that limited to BRICS, or is that other nations trying to limit use of the dollar in those ways?
Certainly, BRICS are leading the way in that respect, and they have done it very effectively. And as a result, Russia has managed to evade all the sanctions that the U.S. and the European Union have imposed on it. And that's why the Russian economy continues to grow, despite all the predictions that it will go into a deep recession.
Much to the chagrin of President Trump, I might add. Maria, really good to see you. Thanks for joining us around the table this morning. Maria Vasiliou, head of Pictet Research Institute over at Pictet Group. And it's a fascinating conversation to set us up for our report from Jennifer Zabasajja. She is, as I say, on the ground for us at the G20 meeting over in South Africa, and we can go to her now. Jen, what is the sentiment on the ground there about the current trade tensions, which seem to be dominating discussions, even if they'd like to focus on other things over there?
Right, Lizzy, I mean, if you ask the South African government, they would ideally like to focus on what they came into this presidency focused on, which is the theme equality, solidarity, and sustainability. But yes, I think that's sort of the overhang that many people are talking about. Even in our conversations that we had yesterday, we spoke with Governor Kganyago from South Africa and also Jan Stoltenberg, and they both talked about tariffs and the tensions that do exist between a number of these G20 member countries. And yet, if you're asking about the sentiment, Kganyago actually reflected that there actually seems to be some positivity that they're actually able to have these conversations. Now, the question is whether or not they're going to be able to find an agreement in terms of finding a communique or getting to a communique by the end of this. And of course, we should note the U.S. Treasury Secretary Scott Bessent is, of course, not here. The U.S. delegation, though, did send a representative here. And so we are seeing the G20 central bankers and finance ministers meeting right now. They're talking about a number of topics and considering the confluence of issues that they're facing both domestically but also globally. It'll be interesting to see whether or not they get anywhere closer to achieving some of the consensus that they're hoping for ahead of the Leader Summit in November.
Yes, and with the US not there, Jen, and the trade conversation very much a distraction and front of mind for many who are there at the G20, does that limit our expectations from the G20 meetings over the next couple of days? What are we expecting to see?
Anna, we did pose that question to a number of the officials that we have spoken with, and they do still believe that there is U.S. engagement. It's not Scott Bessent, of course, as we just mentioned there, but there is still U.S. officials who are here on the ground. And there are still a number of issues that all of these G20 members have wanted to bring up and at least discuss. But really the question is, where do the priorities lie in terms of a number of these countries? At least as far as South Africa goes in terms of its G20 presidency, it was prioritizing a number of issues for the Global South, MDB reforms, also debt sustainability and climate finance. And the question is whether or not they're going to be able to get some of the bigger G20 members on board with that. Later today, we are going to see UK Chancellor Rachel Reeves is going to be here. She has a number of meetings with investors and companies as well. And so potentially it's not going to be dominating all of the discussions that are had here. They're also planning to talk about things like productivity and AI, also cross-border payments, which of course is dominant in the Global South. And so, we'll see whether or not they can find some consensus. But I think, as Governor Kganyago said to me, there's a lot of uncertainty, so it's really hard to nail any sort of decision making right now. So we're going to watch out for what they actually come up with over the next 2 days.
Jennifer, thank you very much. Jennifer Sabasaja, our Chief Africa Correspondent, thank you very much for joining us. Lizzy, we need to pivot to a conversation about the banking sector.
We do indeed, because we've had lots of Wall Street banks reporting record revenue hauls as they reap the benefits from all of the volatility around tariffs. The details are coming up next. This is Bloomberg.
They've got money in their accounts, they're employed, and the wage growth has been relatively strong. And so they're in pretty good shape. The credit quality is good. They have equity in their homes. They're low rate financing in the mortgage. So consumer is pretty good. When you go to small businesses, that's more the question, small, medium-sized businesses.
Bank of America's CEO Brian Moynihan telling a pretty positive story there about certainly the US consumer right now. Staying with the US and the US bank earnings season, and Goldman Sachs stock traders have posted the largest quarterly revenue haul in Wall Street history, raking in just make sure I read that right, $4.3 billion of volatility sparked by the Trump administration's trade war. Across the top 5 US banks, first half trading revenue surged by $10 billion year over year. Joining us now is Bloomberg's Jenny Surain, who has been entirely focused on the US bank earnings story and all of the traders are delivering. Jenny, good morning to you. So which of the trading desks, what are the trading stories that are really delivering here for Wall Street?
So definitely the stock traders. I think, as you mentioned with Goldman Sachs, that was pretty indicative across the board. We saw really big gains from all of the major banks in the U.S. On the fixed income side, we saw a really high level of activity on rates desks, on the currencies desks. So, of course, all these things that would be, most directly impacted by the tariffs and kind of the U.S. trade policy discussion. So really broad-based gains for these banks. It was a really stellar quarter for them.
And so volatility has been good for trading, but bad for deal making. We were debating earlier, Jenny, with Mark Cudmore, whether actually the next half of the year could see boardrooms getting used to the volatility and actually deal making picking up, because we were meant to see
loads dubious of this view, wasn't he? But it was a nice question to ask.
Oh, I'm optimistic, but look, because deal making was meant to kick off under Trump, and it's the opposite.
Yeah, no, we actually heard a lot about that this week, and I think what we heard from these CEOs was all these clients are still really hyper-focused on the uncertainty and the tariffs and kind of where those net out. As soon as they get that certainty, the CEOs really were confident that we will see that pickup in deal-making. But I think that's a matter of, when and kind of how soon they get that certainty.
When do I get to put certainty in my diary? I don't know. When is that day? I'll find a calendar to put it in. So what is the outlook for trading from here? Because it's one thing to report backward-looking numbers that have been driven by volatility and you've benefited and fine. That's been good. But what does that tell us about their ability to keep delivering on that?
Yeah, trading is a tricky one because it's not like past performance indicates future performance. So it'll be interesting to see. Volatility is really difficult, actually, for these trading desks. They have had so far kind of that Goldilocks moment for volatility. So it was just enough to get clients active and engaged. They wanted to be playing these markets. But sometimes it can be too much, and then they get scared and they sit on the sidelines and kind of wait it out. So if this volatility persists, do these clients kind of get that fatigue and start sitting it out, and then, you see that revenue come down? It'll be sort of, it's hard to know in advance, but it'll definitely be something we're keeping a close eye on.
Well, with past performance in focus, who's been the biggest winner? Is it obvious?
I think Goldman was the big winner this quarter. I mean, the stock trading numbers you guys talked about earlier, obviously really strong. Their deal-making numbers actually came in really strong. So they finally retook that -- crown in deal-making back from JPMorgan. It was a big loss for them when they lost it. So I think Goldman had, it was kind of firing on all cylinders, as it were. The other big one this quarter was Wells Fargo. They have a little bit of a smaller trading and investment banking business, but they lost their Fed asset cap just a couple weeks ago, and they had lots of good things to say about, plowing into new businesses and kind of taking advantage of this moment.
All right, well, those bank earnings really helping to fuel the rally that we saw yesterday on Wall Street. But it wasn't, Jenny Serrain, we thank you so much. But of course, it wasn't just about the banking earnings story. It was also about the relief on the central banking story. Donald Trump saying that he did ask Republican members of Congress whether he should fire the Fed chair, Jerome Powell, but then saying that he has no plans to get rid of him, despite his recent criticisms.
And the fake news is saying, oh, if you fired him, it would be so bad. It would be so bad. I don't know why it would be so bad.
So we have a stupid person, frankly, at the Fed. I call him Too Late Powell because he's always too late. I know within 3 or 4 people who I'm going to pick. I mean, he goes out pretty soon, fortunately, because I think he's terrible. I'd love him to resign if he wanted to. He's done a lousy job. Jerome Powell's been very bad for our country. We should have the lowest interest rate on earth, and we don't. He just refuses to do it, and yet he's spending $2.5 billion rebuilding the Fed. He's a terrible Fed chair. I was surprised he was appointed. We're not planning on doing anything. We're very concerned.
And after all of that, it seems Powell is safe for now. Or is he? Let's bring in Bloomberg's Valerie Teitel. Val, the president saying that the Fed chair is safe for now, with this massive caveat, can the market forget about it?
I don't think so. I think they're going to have this on their mind up until we actually hear the Fed appointee, whenever that comes sometime next year. It is normal course of action that the Trump administration should pick the Fed chair just a few months prior to May, which is when Jerome Powell steps down. So we have to wait until then to get some sort of clarity. But I think the markets will have to deal with the risk that we could get an escalation further from the White House between the White House and the Federal Reserve. I think yesterday was a real eye-opening on just how the markets would take it. I mean, it was really pretty incredible, the hour of trading where we did see this Sell America theme come back, where all U.S. assets traded lower, whether it was the U.S. dollar, the back end of the Treasury market, or equities going lower. It was funny to see, even in that 90 minutes of chaos, that we actually priced in one additional rate cut until the end of the year just on this chaos. Now, a lot of that was unwound, but I think that gave us a glimpse of the price action we could see if this was ignited further.
Yeah, I mean, and of course, the market's focus is on what this means for policy making, what it means for the Fed independence, all those big questions. But just on a personal level, I mean, what an incredible amount of pressure to be under as one person, to have your boss or the person who employed you in the first place using that kind of language that we just replayed there to describe your performance. Quite incredible, really. But back to the markets and what we saw there, Valerie. I mean, is there any sense... So Mark Cudmore was talking earlier on about what we've lost already on Fed credibility as a result of all of these conversations and all of that rhetoric we've heard from the White House. Is there anywhere to watch that develop and play out in the market? I was wondering about the short end, the way we see it move on President Trump's comments around Jerome Powell. Does that tell us something about how much the market thinks the White House is in charge here, not the Federal Reserve?
Well, going forward, it'll be very interesting to see if we start getting dissents in these decisions. It's something that Powell has not really had to deal with a lot during his time as Fed chair, but we've heard hints already. There's been two people who voiced support for a cut in July. Whether that comes into an actual dissent of the decision will be very interesting. But that's the kind of political pressure, Anna, that could show up sooner rather than later. Maybe not Chair Powell changing his mind, but others on the board not wanting to invite this kind of criticism and maybe wanting to throw into their hat into the ring for that Fed chair job, and dissenting at one of these decisions would be, a way for them to do that. And that's already kind of how you can understand how this political pressure is already making way through the Fed. But remember, come next year, it is really not just the Fed chair that Trump has a pick on. There's also Adriana Kugler, who's stepping down in January. That's another Fed pick. And then if Powell also vacates his Fed governorship, which is a normal course of action for a chairman stepping down, that would be 3 seats on the board for Trump to choose. Remember, the board of governors is only 7 seats, so that's, 3 out of 7 seats are available for Trump.
Yeah, a lot of shaping then that he could do of the Fed. Lizzy and Val, let's have a moment on the UK. We had the UK data out this morning, firms cutting jobs, wage growth slowing in a cooling labour market. This on the day, this is the bit of stagflation, and yesterday we got the flation bit of stagflation, with that CPI print coming in 0.2% higher than had been anticipated. I mean, what does this do to our expectations around the Bank of England?
Well, actually, you can see that traders have slightly pulled back their bets on BOE rate cuts off the back of this. You've got gilt yields higher across the curve. I also just think it's a bit of a nightmare for Rachel Reeves, right? That to have unemployment at its highest rate in 4 years.
Yeah, if we can trust the data, of course. In particular, the percentage, that unemployment percentage, I think that's the one that markets have steered away from for a while.
Yeah, no
one
wants to pick up the phone for the labour force survey. But, the Chancellor being blamed by companies for raising the minimum wage and raising taxes. So, it's a nightmare for both the BOE and the Chancellor.
Yeah, and I know what you just mentioned about whether we can trust the data, because that's also not just a concern in the UK, it's also a concern in the US, that nearly 30% of the CPI basket was an estimate for that Wednesday's print. So it's really not just, I guess, the credibility of the UK's data, but a lot of data being pulled into question. And, a lot of central bank decisions hinge off the back of this data.
OK, thank you, Valerie. Valerie Seisel with us on a few of the market themes we're dealing with this morning. No doubt the relationship between the Fed and the White House will persist as a market theme. Let's go to some of the stocks that are gaining this morning then, and we've got on this board for you ABB, Legrand, Schneider Electric, Ocado. The first three are all united by sort of data centre themes, a little bit different other themes in regards to ABB, but there is some of that permeating through there, and we've had earnings from Legrand and from ABB. Schneider Electric up in sympathy, it would seem. And Ocado, we heard some numbers from them as well, Lizzy. You've got, on the negative side...
I don't know how I wound up with the losers.
Why don't we end with this?
We've got EasyJet down, their profit growth hit by fuel costs, Wise down, underlying income missing estimates, and Novartis down, even though it lifted its outlook on those quarterly profit beating estimates.
OK, private markets in focus next. Per Franson, the CEO of EQT, will be speaking to Francine Lacroix next. This is Bloomberg.